Welcome to CryptoChicks Corner, an educational podcast to teach you the basics of blockchain technology and how to harness it to start or expand your own business. CryptoChicks is a nonprofit organization on a mission to grow the professional and leadership potential of women in blockchain and artificial intelligence. I'm your host, Ashley Spradlin, and welcome to our corner. Welcome back. Now that you've learned a bit about blockchain and cryptocurrency and how wallets are used, let's talk coin. But first, please remember none of this is financial advice. If you're hoping I'll tell you where to invest your money for big returns, you've come to the wrong place. CryptoChicks' mission is to give you the education and tools to empower yourself on your financial journey. We want you to know how to do your own research on what is and isn't a wise investment for your future. We'll provide some context for understanding so you can apply what you've learned to make informed decisions. So, you've heard of Bitcoin. Maybe Elon Musk brought your attention to Shiba Inu. Ethereum, there are so many tokens out there. What does it even mean to purchase a coin or a token? What's the difference? Let's start with clearing up a common misconception that buying cryptocurrency is like buying stocks. When you purchase a stock, you are buying a share of ownership in a business. That stock is backed by the assets and cash flow of that business. The price of the stock changes based on the potential value of the company's success. Now, buying cryptocurrency does not give you a share of ownership in a company. Essentially, the prices of cryptocurrencies rise and fall based on public perception. That's not to say stocks are not influenced by the socioeconomic climate or public sentiment, but the key difference is most cryptocurrencies are not backed by tangible assets, though there are some exceptions, which we'll get to in a moment. Many crypto assets have provided investors huge returns, and many more have suffered huge losses. The market can be volatile. Regulation, or lack thereof, is still quite muddy, and it's a high-risk, high-reward game for anyone looking to turn a quick profit. While I won't ever tell you what to do with your money, I do encourage you to think about the long-term development of any investment and be sure you understand what you are buying before you throw your money in. Crypto lovers say investing in cryptocurrency is beneficial because it's not controlled by any banks or central governments, and it could provide a hedge against the inflation of fiat currency. Check out episode 1 on Web3 for some background on why cryptocurrency was invented, and episode 3 for more on the evolution of fiat currency and the banking system in the US. Alright, so you've heard of coins and tokens. Is there a difference? Yes. All coins are tokens, but not all tokens are coins. Coins are the native currency to a blockchain. Bitcoin, for example, was created for monetary uses and has its own chain, so it's considered a coin. Tokens, however, are built on an existing blockchain, like the Ethereum or Metis networks, and they can serve many purposes. Many tokens are referred to as utility tokens because they can be used to perform certain functions on a network. You can use utility tokens to exchange funds, deploy smart contracts, or really anything the creator wants the token to be used for. Ether, or ETH, for example, the currency of the Ethereum network, can be used to exchange, but is also needed to perform transactions on the network, as you must use ETH to cover any transaction or gas fees. Sometimes tokens offer a governance benefit. They represent voting power in a project. In many cases, the more governance tokens you hold, the more say you have in voting matters of a DAO. DAOs are organizational structure in Web3 that I'll be sure to cover in a future episode. But as you can see, it's important to have a clear understanding of the functions of the crypto you want to invest in before you buy. Alright, on to types of coins. Bitcoin is the first ever cryptocurrency. It was created in 2009 by Satoshi Nakamoto. Satoshi is a pseudonym. We don't actually know who created Bitcoin. It could be one person or a group of people who brought the vision of a digital currency with no central point of control to life. Bitcoin is the most popular, widely adopted, and accepted currency on the market today, and in terms of market capitalization, which is basically the total value of a project as perceived by the public, it's the most valuable asset on the crypto market. Any coin or token that is not Bitcoin is considered an altcoin. or alternative coin. Ethereum, Metis, Aave, Dogecoin, all altcoins. Stablecoins are the exception to the rule I mentioned above about cryptocurrencies not being backed by tangible assets. The value of a stablecoin is pegged to the value of another asset. In other words, they have underlying collateral, which makes their value more stable. That's not to say the value doesn't fluctuate, but it does so at a much smaller degree than other cryptocurrencies. There are a few types of collateral structures for stablecoins: fiat-backed, crypto-backed, commodity-backed, or algorithmically backed. Fiat-backed stablecoins are pegged to the value of a fiat currency, like the US dollar. They're usually pegged at a 1-to-1 ratio. 1 US dollar equals 1 stablecoin. Tether or USDC are a couple of examples of fiat-backed stablecoins. The idea is that each, let's say, USDC coin can be exchanged for 1 US dollar, and for each coin in circulation, $1 is held in a reserve to back that asset. If 1 million coins are issued, then $1 million must be held to back those coins. Crypto-backed stablecoins are backed by other cryptocurrencies. Because the value of cryptocurrencies can fluctuate dramatically, crypto-backed stablecoins must be over-collateralized. That means if your stablecoin is valued at $1, the cryptocurrency backing it should be valued at $2 to leave some wiggle room for the value to fluctuate. These are less stable than fiat-backed stablecoins, so it's important to watch the price of the cryptocurrency backing your coin. Commodity-backed stablecoins are backed by physical assets like gold, silver, oil, or real estate. They also have a 1-to-1 ratio, meaning each coin is worth 1 unit of whichever commodity backs it. One coin might be worth 1 ounce of gold, for instance. Values for the real assets that back these stablecoins can also fluctuate often, so be mindful of those markets when investing. Algorithmic stablecoins do not have an asset backing like fiat, crypto, or commodity-backed stablecoins. Their values are still pegged to the value of fiat currency, but none is held in a reserve to back the asset. Algorithmic stablecoins are a little trickier to understand because they use an algorithm to adjust the circulation of the coin to control value fluctuation. Basically, if the value of one algorithmic stablecoin drops below the value of $1, the algorithm will reduce the number of coins in circulation to increase the value of the coin. Think supply and demand here. Or if the value of the stablecoin exceeds the value of the dollar, the algorithm will circulate more coins to bring the stablecoin's value down in line with that of the dollar. Stablecoins are open for anyone who can log on to the internet, which is huge for people who may not have access to traditional financial services, the US dollar, or other assets like gold. They're easy to send anywhere in the world quickly and cheaply. They can often be saved or invested at higher interest rates than traditional banks offer, which is why stablecoins are beloved in the crypto community. Even governments are taking notice of the stablecoin model as they explore government-backed digital currencies. That's a whole other conversation though, so let's pause here to process what we took in today. If you have any questions about what we covered in today's episode, please reach out to us on any of the channels in the show notes. Also, we're hosting a giveaway for our listeners. All you have to do to enter is rate and review this podcast, take a screenshot of your review, and head to the link in our show notes for instructions on where to send it for a chance to win $100 of Bitcoin, Ethereum, or other cryptocurrency. There are also social media sharing options that will gain you more entries to win, and we really appreciate your support. Thanks so much for listening. Until next time. Thanks so much for listening to this episode of CryptoChicks Corner. I hope it was helpful. Be sure to subscribe to our podcast so you're notified when we release new episodes to build on what you just learned. We would love for you to take a moment to rate and review the show to help us serve more entrepreneurs. And remember that anyone can join our CryptoChicks Academy to take courses from experts in the field, and our hatchery can help you transform your business idea into a well-funded startup. Check out our show notes to get started, and we look forward to seeing you shine. This podcast wouldn't be possible without the support of our incredible sponsors. Women of Crypto is an NFT avatar collection that's the first of its kind, 3D rendered, and meant to represent the diversity and beauty of every single woman in the world. Their efforts are invested to bridge the gender gap and inspire and invigorate more women to participate in the world of crypto. Women of Crypto is a Metatora project, and we're so proud to partner with them. We also want to thank Metis. Metis is an Ethereum Layer 2 optimistic rollup platform to help you launch into the Web3 economy. Their platform harnesses the security and decentralization strengths of the Ethereum network with the added benefit of fast, low-cost transactions, native storage, and a user-friendly interface to make deploying your project simple and stress-free. Whether you're expanding projects in decentralized finance, NFTs, gaming, community, or you want to take your Web2 business to the next level, Metis is the platform for you.